Good afternoon, friends. Thank you so much for attending this Facebook Live webinar. I'm Mayuresh Joshi, Head of Equity Research at William O'Neill India. And in continuation of all the series that we have been doing over the past 7 weeks, this is the seventh edition where we are trying to find some sense in terms of how differentiations the market makes from a value and a growth perspective. Now, there has always been arguments in terms of which methodology is better, value or growth. And we try to stress upon a few of the relevant elements related to both value and growth investing at this point of time. So again, I think market conditions differ between phases. And as market conditions evolve during each of these phases at hand, and we have seen a variety of these phases over the last 4 weeks. We are in fine fettle till the end of January. The pandemic happened, and the issues related to the pandemic started playing out ferociously on equity markets, and the risk off was pretty intense. So the sell-off that you saw for global equity markets had a huge repercussion in terms of the asset class. The second element was the kind of pullback that we've obviously seen, the announcements that a lot of federal government, central bankers have done in terms of rate cuts, and the expectations of providing huge amount of stimuli for the economic and the financial damage that the economy might face over the next few months. So the market is trying to get some respite. So I think we've seen a roller coaster of sorts. Add to that what happened with oil, the crash of oil prices, and the resultant effect in terms of the credit risk averseness that is playing out in the system itself. I think all these factors have probably played out on the markets. So to elucidate the point, I think the stocks that we probably be looking at in the webinar is just for information purposes, just educational purposes. In no way should it constitute to be investment advice. Now we'll briefly touch upon what value investing is, what growth investing is, and we'll try to zoom in on some points related to value and growth investing as well in terms of the key attributes that are paid attention to. Now, what is value investing in the first place? So the whole aspect in terms of growth stocks versus value stocks lies in the differentiation in terms of how the placement of these stocks are within the entire pyramid, whether it's a large cap, mid cap, or a small cap, which sector do they lie in, and how are the valuations perceived to be in terms of both trailing earnings and expectations of forward earnings in the spaces that they operate out of, and whether they can create a huge difference at the multiples that they are operating out of. So I think the more granular way of approaching value investing is probably to have an estimation in terms of how the book value lies. How do you probably compute the book value? I think that is what we'll touch upon going forward as well. So the price to book metric, the price to earnings metric, what happens in terms of discounted cash flows as a metric as well. I think all these attributes probably need to be understood from a value investor's perspective and from a value investing perspective to see how the stock is positioned at this point of time and whether it can greatly outperform over the next few quarters and years, both in terms of how its earnings stack up is and how the entire book value can actually multiply, assuming a lot of things going right in the direction that it wants to. So I think a few examples of what we've given out in terms of how value investors and what value investing is all about. So I think it's basically trying to find diamonds in the rough. I think a simple logic here is that there is too much strewn on the floor, but how do you find a diamond which can outshine over the next few years? So initially, I think you might see a lot of stones lying littered around the ground, but how do you pick that diamond in that rough itself? I think that is what value investors intend to do, and their entire logic and premise is based on the concept of picking companies where stock values is lesser than the fundamental values or the book value at play at any given or a particular point of time. Now, stock prices can be highly irrational because the markets can be irrational at certain points of times. So I think the best way that a lot of analysts assume certain things is the past assumptions in terms of growth, how the growth has been, how the trajectory of growth can be expected to be presumed and assumed over the next few quarters and years, and how their multiples have probably fashioned up over the last few quarters, which gives some amount of standard deviation in terms of their base earnings from a price to book or price earnings multiple. So I think you get a common logic in terms of FMCG stocks being traded at extremely high valuations. Because I think the past presumptions have been that they've been growing at a certain rate, and they might grow at that same pace or a little bit better, considering the kind of growth that these companies can themselves generate, or how the entire ecosystem from a macro perspective can help generate growth. And now within that group itself, I think if certain companies are able to grow faster, both because of product innovations at their end, both because of niche offerings that they've got, where there is no competitors and where there is a very, very strong moat. So I think that is the entire concept that a lot of value investors look at. At the same time, I think the valuations from a earnings metric perspective also have to be very, very reasonable. So again, value investors look at stocks which are trading at bargain prices. The general assumption is that these stocks should be having lower price earnings multiples, lower price to book multiples. But in this scenario, I think when you're talking about larger earnings growth coming through, I think generally, I think higher P multiple stocks do not fall into the radar of value investors or higher price to book, because to a large deal and to a large extent, these stocks with their higher multiples in stride have fathomed in the kind of higher earnings multiple that these companies will keep on posting over the next few years. So in that respect, the expectation that every value investor probably has is that the market will realize the company's real worth over a period of time, and ultimately, I think the prices, which are very, very irrational in terms of the future growth prospects, that the present value of the stock prices are not reflecting, will get reflected, and they will get reflected in a significant manner as all these numbers start tickling through, both from a top line perspective, which also happens from an efficiency perspective, which happens on the operating level. And subsequently, as a result of both these factors, the bottom line growth becomes extremely strong, extremely robust, and grows as a much faster clip, giving valuations a run for the mill. So I think that is what the general seeking points are. Now, stocks, to a certain extent, as we all know, can be undervalued for many, many reasons. So I think how these perceptions are for a stock value trading below its market price. You would have heard a lot of market commentary. You would have heard a lot of statements in financial reports, a lot of analyst reports, that it is trading awfully cheap. It is trading awfully cheap below its market price, and its price to book multiples are below one. We often cite these examples for public sector banks, for example. So a lot of public sector banks, a lot of public sector undertakings at this point of time are trading significantly below book. So whether that's 0.3 times book, 0.4 times book, 0.5 times book, anything below 1 time book is probably considered cheap. And the cheapness is because I think the entire book value that the entity carries at a certain point of time, the market is not trying to factor in that whether this book value is justified. But the book value probably takes into account a whole deal in terms of the tangible assets that it has got, and excludes a large element of liability. So to a certain extent, if a firm or if the equity value needs to get recognized, or the firm is liquidated at any given point of time, obviously the fair assumption is that all companies will be going concerns, which means that they last over a longer period of time in a time series equation. I think the assumption that one draws that at any given point of time, if you probably drop the assets, tangible assets, if you drop the liabilities, whether the firm has the capacity to pay their liabilities off and still survive at any given point of time. So I think that is where the entire concept of finding undervalued stocks come into play. But the other element, as I was just discussing, is that they can become undervalued for a lot of other factors, a lot of other reasons as well. There are some cases where I think public perceptions push the price down. So I think if there is some major issues that the company is embroiled in, I think that is somewhere where the stocks can actually start coming off. Now, if these issues are very, very serious at hand, if these issues are somewhere where there are proprietary concerns being raised, governance issues being raised for companies, I think the entire concept and the entire logic and notion of how the book can sustain, and whether the book value itself is a sustainable portion or fraction that can be considered becomes a huge question mark. Case in point, I think anything which happens fraudulently in terms of the company's books, and once that becomes public, for example, I think the kind of deterioration that it takes because of corporate governance issues, whether the company is following the right path in terms of reporting numbers and whether the reported numbers are genuine and true itself, I think that can cause a huge amount of concerns. But then there are some valid reasons for which the company's uh, uh, stock prices can move down. So if the company's financials still remain extremely solid, they're extremely robust, but it is because of some cyclical conditions in the markets. I think that is where I think the stocks actually start coming off quite significantly. And then there is all these bargain hunting that value investors probably look at. Now there again are disputes within the whole argument. Uh, Again, I think to cite the example of public sector banks, I think what happens in terms of public sector banks' valuations at any given point of time, I think they have been very, very cheap for some length of time over the past few years. They continue to remain cheap, but the susceptible portion for public sector banks is the entire concept of whether their book value will survive over the next few quarters and years. The asset quality deterioration that we've seen, that is precisely the point that I was harping about in terms of company financials, whether they remain solid enough through peak and trough times. During peak times, yes, I think they grow at a phenomenal pace. During tough times, whether they're able to survive and whether this business model is robust enough to survive the kind of fall that we see from a macro and a micro perspective as well. So, with that perspective, these companies are able to follow through and secure their positioning. Yes, earnings will take a hit because the markets do presume, like in this scenario as well, that quarter 4, quarter 1 earnings for a large amount, I mean, for a huge amount of sectors, a large number of companies are going to feel the pinch. And maybe that softness continues in Q2 from an Indian gap accounting perspective, which means that the annualized earnings will take a hit for a majority of these companies. I think if there are valid reasons like this, value investors will then try to find out within these sectoral rotations which company is probably positioned best from a balance sheet perspective, from a corporate governance perspective, from a product positioning perspective, and where the earnings recovery can be faster compared to the others. So I think not everything that is a low P, low PB can be considered to be attractive. I think value investors do understand that as well. But again, I think we shouldn't be falling into a classical trap because what generally happens is that you probably get attracted being a new investor in the market, looking at price to book, price earnings multiples, and saying that, oh, this probably looks cheap, I should be getting into that. But there are valid reasons uh, apart from the reasons that certain companies might hold out. I think certain companies in that entire value chain or peer comparison might actually be also be feeling the heat because they do not have the competition intensity to compete with the leaders within these same spaces. They do not have the product innovation. They probably do not have the right resource mobilization to probably carry them through the next few years. And they might be probably languishing in terms of how the entire aspect will be over a period of time. Now, to carry forward the point, the dividend distributed in these type of companies, I think they also typically benefit value investors from huge dividend payouts. So I think they are high dividend paying companies, which means that the return to shareholders is quite significant for value investors. Again, at what periodicity and how the dividend payouts happen, because I think across market conditions, it's impossible to maintain a certain rate of dividends in peak and trough cases. But I think the dividend payout is far more consistent for these companies. And because they are well managed, I think they can survive the crisis through a period of time. So I think that is one more point that we should probably be looking at. Again, from a return perspective, I think the general presumption for value investing is that it can be a safer investment than growth stocks because I think generally they tend to underperform in terms of market movement when markets are in momentum. But during the initial phase of the markets, I think what they probably tend to do is I think a lot more emphasis gets drawn towards how these stocks are perceived at a particular point of time, where they lie within the entire macro and the micro positioning of the markets itself, and how their potential can be unlocked over a period of time, which means that they tend to be safer investments from a medium to long term perspective, from a value investor's profile. compared to growth stocks. Just to carry the point forward for value investing, I think the important points to note here, as I said earlier as well, I think they tend to typically trade at a discount. So I think price earnings, book value, or the discounted cash flows. So with that respect, value stocks, at least theoretically, are considered to be a lower level of risk. The volatility associated with them are a little bit better compared to the high beta correlated stocks because they are usually found in better established companies, better corporate governance companies at any given point of time. Uh, the third element that I was saying is when you probably look at value investing and the entire concept of uh, how the perception has to be from a numerator and a denominator perspective for value investors. I think the numerator and the denominator has to be same. So what I'm trying to indicate here is, for example, I think if the equation that you're probably looking at is price earnings. So I think the numerator, if it's price, I think the denominator has to be an earnings equivalent itself because price earnings both have equity values attached to that. So I think value investors pay a lot of attention to this aspect as well. A second example probably is that if you assume numerators to be an enterprise value, the denominator in this case should be an operating value. So for example, I think if the numerator is an enterprise value that you're probably looking at, the denominator then becomes EBITDA, which is the earnings before interest and tax, which is an operating value at place. So I think value investing will have different elements and connotations in terms of approach and how the future forecasting happens. Now, in terms of calculating the intrinsic value, because as I said, for value investors, getting to the book, getting to the intrinsic value is extremely important and extremely pertinent. So I think forecasting the future growth, forecasting the margin improvement that these companies can exhibit, forecasting cash flows. So all these three elements are extremely critical and pertinent in terms of calculating uh, the the uh, the intrinsic value, and also they have to have a huge amount of emphasis in terms of the multiple assumptions that they are having. So for the three aspects that I just discussed for the IV part or the intrinsic value that needs to get discussed, the value investors also try to have multiple assumptions, which is an extremely critical element in terms of growth, in terms of risk, and in terms of investment efficiency. So how will the company grow? What are the risk factors involved, both from a company perspective and the risk elements that you are probably perceiving from a value investing perspective on whether the stock can be able to deliver or not, and how the investment efficiency will play out in efficient conditions that the stock can perform going forward. I think just to cite a simple example, I think if you probably look at a 100p stock which is trading at 100p on a trailing basis or a 10 to on or a 10 times price to book basis, I think the 100p is basically based on the assumption that the earnings will be growing at that similar pace over the next few years, while the 10p or the higher price to book multiples are basically trying to find out that the stocks can generate a higher return on equity. So I think price to book and value investors probably have a look at that the return on equity also probably can be growing at a reasonable amount of clip, and they can get generating and they will be generating a higher ROE over a medium to longer period of time. Now, growth investing, I think as I said, I think growth investing can be found in multiple elements as well. So I think it's not just restricted to a particular set of stocks within a particular set of market capitalization universe. So growth investing can be across market caps, and I think growth investing companies are considered to be a good chance because they expand quite significantly over a shorter to medium time frame. So growth investing and growth investing companies are high revenue growth companies. They generate high cash flows because the revenue or the top line is growing at a stupendous pace at a particular time period, and because they are generating huge amount of top line and because the operating performance is also expected to be very good, I think the operating cash flows that these companies throw out are extremely superior to value companies at a particular time series and given for a particular periodicity of time. And because I think the cash flows are so very strong, I think the profitability that these companies throw out is far better over a period of time. Now, the management of growth companies, I think they generally reinvest their earnings in order to expand. So I think in value companies, what you've probably seen that whatever gets generated in terms of the bottom line, I think the shareholders are rewarded in terms of dividend payouts. I think dividend is not more or less distributed, but I think the retained earnings, as we call it, the retained earnings are invested back into the business because they are growing at a particular pace. If they want to continue growing at that particular pace, it is essential and it is very, very pertinent that companies start plowing back all the profits that they've done, the cash flows that they're generating from their normal business activities get plowed back into the business so that the generation of capital and the return on capital employed, both from a capex and an operating capex that they probably and the operating capital expenditure that they probably do, generate faster amount of top line, which means that the asset turnover or the top line growth is happening at a much faster clip compared to value companies, and therefore they're growing at a very, very fast pace, which means that the infusion of capital, infusion of cash is required periodically and every period of time to enable them to keep on growing. Again, I think the dependency in terms of generating cash from internal accruals is far higher because I think the management is far more reliant in growth companies to depend upon their own accruals and not on the external one, considering the cyclicality of their businesses, which can be prone to a sudden downturn, which can also hit their interest coverage or their debt to EBITDA ratios if excessive leverage is built on their balance sheets. Again, growth stocks, as I said, are very, very prevalent in terms of very, very strong market moves. So when the market is moving at a very, very rapid pace, growth stocks tend to outperform value stocks at even given period of time at that point of time, because I think a lot of investors, traders at that point lay emphasis in terms of all these stocks and sectors which are growing faster than what the value stocks will normally grow at a very, very at a very, very steady pace, as I said earlier in my earlier slide. So I think the expected growth that you've got for value companies of 10-15% as an example, growth companies in a momentum market or in a strong market where liquidity is strong, where all the macros are firing on all cylinders and where the micros look extremely robust from a demand perspective, tend to grow at a very, very fast pace, as I said. And therefore, I think the high beta correlation that these stocks have compared to the to the value stocks is far better. So again, as I mentioned earlier, when I was editing the note for the value investing point, I think the volatility is something that you need to take into account because volatility will be very, very huge. The risk endured to achieve them is also expected to be far higher in terms of growth stocks, unlike value stocks. Because I think, as I said, the assumptions that a lot of value investors make in terms of numerator, denominator, in terms of forecasting future growth, margins, cash flows to find the intrinsic value, and the multiple assumptions that they make for growth, risk, and investment efficiency, I think those assumptions are a little bit tapered down when it probably comes to growth investing stocks. A third element, obviously, is how these stocks perform. So growth stocks, again, perform, as I said, exceedingly well when markets are in a huge momentum kind of fashion. So, for example, I think in the recent fall that you've seen, from 7,500, the intraday low collection that we probably witnessed on the index itself, and the huge pullback that we are still witnessing, almost are touching around 10,000 odd levels. I think the kind of spur that you would have seen in certain stocks were based on the assumptions on some element of short covering which initially occurred in the markets, B, some element in terms of macro announcements that could aid and assist certain sectors, and therefore certain presumptions in terms of growth staying with certain companies being very, very pertinent. So I think the V-shaped recovery that you saw for a couple of sectors, for example, pharma, to a certain extent FMCG, and to a certain extent within the broader universe, specialty chemicals, I think the presumption here was that the earnings momentum might still continue for a whole host of these stocks. And every stock within this universe was probably moving at a fast clip compared to the others. There were bargains at play as well during the entire fall that we probably saw. And there were deteriorations in terms of value as well. So I think the deterioration in terms of book value. And there again, I think certain sectors, for example, banking, the private sector banks, which are performing exceedingly well till the end of January, I think had started coming off significantly because the concerns that were getting played out on public sector banks, I think similar concerns start getting raised. And this happens during every market fall and correction. And there are multiple questions and doubts that start getting raised in terms of how the entire element might phase out for these stocks. And the entire multiple assumptions on a forward basis started cracking downwards for private sector banks. So the assumptions in terms of how these banks were trading at, from a price to book multiple, from a price earnings multiple, and they were not cheap by any sense. I think the markets then started having these assumptions in terms of how these stocks will fare, and then the immediate reaction was that the stocks might actually start reporting annualized numbers which are far lower than what we had probably presumed a quarter back on a forward presumptive basis. So I think this is what happens, and when the multiples start coming off quite significantly, I think that is where the question marks start coming out. But here again, I think value investors start jumping in, and they try to probably stack up, for example, within the entire private sector banking basket of what probably looks good, who can stand the test of time over the next few quarters, what kind of assumptions can I draw from a growth perspective, what kinds of assumptions can I draw from a risk perspective. How bad will the asset quality be? How much provisioning is required? Whether the banks can survive the next 2 quarters? Whether they have the liquidity coverage to probably ensure they can go through? Whether they can raise capital, is capital adequacy, both from a tier 1, tier 2 perspective, itself good on their balance sheets, which can help them survive and again endure once the fall is over and once the demand starts coming back to grow at a pace that they were growing earlier in terms of balance sheet expansion, whether they can stand over competitors at any given point of time, whether they can increase their moat in terms of market share compared to public sector banks or the other private counterparts at that point of time, and how far is their investment efficiency theory actually working? Are they doing exceedingly well in terms of uh, uh, how the entire book is expected to function, whether that book can grow at a very, very decent pace, and whether that entire book can survive itself. So I think assumptions are drawn. You've got assumptions on all these factors. You've also got future forecasting done in terms of earnings growth, as I said, and how the cash flows will come. So I think all these assumptions basically are extremely critical. And that is how I think we position ourselves. And that is where value investors come to the fore in market conditions like this. In terms of stack up and then probably coming out and then probably assuming and identifying 1 or 2 key stocks within this universe itself as an example, which probably have corrected quite significantly and which can revert back to its mean or its standard deviation efficiency historically over the next few quarters. I think a few multiples which are taken into account. But before that, I think what we typically go through in phases of the market like this, I think it's very important and pertinent to know this as well. I think we're obviously going through 3 phases at this point of time, where all these multiples are going to come into account and come into reckoning at every periodicity of time, what we've seen in the past 1 month, and presumably over the next few months as well. I think the first phase that we all witnessed by the end of by the middle of March was how the stock markets reacted. So it was obviously a shock phase for the markets, and markets quite didn't realize the impact of how this entire pandemic will happen, how the financial and economic deleveraging will happen, and the stock prices crashed. In terms of the trailing earnings. So I think how the trailing earnings were playing out, and then sudden realization in terms of how that quarter earnings will get affected and whether the trailing earnings will not get sustained. I think that is something which caused a huge amount of shock realization in terms of a valuation perspective. The phase 2 is obviously the adjustment. So I think the markets now will try to adjust over the next few weeks and months in terms of trying to identify sectors, in terms to identify stocks within those sectors. And then the investors will try and now probably start fathoming, and investors and analysts as well, that Q4, all right, is was expected to be a little bit soft. The companies have already started reporting numbers. Q1 numbers, okay, I think the lockdown pressures are accentuated. So, for example, I think the auto numbers that you're seeing, I think every auto company for the month of April is expected to report a zero number. So, I think there have been no sales because of the lockdown. So, what actually happens in terms of the entire stacking up in terms of the volume numbers for auto companies for the entire quarter, I think it's expected to be very, very soft, even if the lockdown, as we're seeing, the pressures get lifted and some sales happening for the remainder of the next 2 months for this quarter. But the entire annualized number is going to take a huge hit. So I think that adjustment factor in terms of how company numbers are going to stack up and how the presumptions on forward multiples, as I've been mentioning, that investors try to reckon and try to stack up. I think that multiple assumptions and presumption basis is something that is going to be trading the market in the second phase. The third phase is when the reality will hit a quarter or two down the line. Now, I've been saying this, and I've been saying in my past two webinars as well. I think they are presuming that the first quarter is bad and the recovery will start in the second half itself. But I think the markets will then try in the third phase, try to adjust the real earnings which come through rather than the forecasted earnings which happen at any given point of time at the beginning of the financial year, like we are doing at this point of time from an FY22 perspective. So when you talk about the second half earnings recovery, and if that earnings recovery probably gets delayed by a quarter or two, for any reason whatsoever, demand not coming back, liquidity issues into the system, macro still not recovering for any reason whatsoever, I think all these factors, if they play out, and if they don't play out to the rule book in terms of the assumptions that a lot of analysts have probably drawn out, I think the third phase is where I think the reality will strike. And that is where I think the stock prices will then start adjusting to the reality. So I think it's an assumption at this point of time where it's a given during this point that earnings it will happen. Let us draw future projections in terms of forward multiples being contracted a little bit for some companies where value investors hunt diamonds in the dust. That some multiples from the 2-year, 3-year perspective can actually be given a higher multiple because they can recover faster. I think all those presumptions will ultimately be put to test a couple of quarters down the line when actual numbers start hitting. And if actual numbers are even lower than what the analysts had pegged at the beginning of the year, I think there can be significant downgrades. There is also an assumption that they can actually perform better, and the assumptions actually go true. Then there might actually be some surprise upside risks that these stocks can pose as well. So everything possibly pegs upon, and as I said, depends upon the assumptions that we've got at play. Now, I'll briefly touch upon points. I think we all must be knowing what all these multiples mean, but I think it becomes extremely critical in terms of both value and growth investing that what kind of assumptions are getting drawn out from a various presumptive perspective, as I said, and these four ratios are far more popularly used. So as I said earlier in my discourse as well, I think the numerator and denominator have to be probably the same. So for price earnings, as I said, if you are taking equity values, the price, the numerator, the denominator earnings are both equity values. So again, I think if you're probably looking at price to book, for example, so the book value of an equity is typically based on accounting measures, right? And the accounting measures give you an indication in terms of the historic cost principles. And again, I think it reflects in terms of how the company has been placed at this point of time. Obviously, the market price is somewhere where the share price is multiplied with the number of outstanding shares, but the book value is somewhere where the net assets of the company are being evaluated. Now, as I said, price to book below 1 is an extremely important peg that a lot of analysts believe upon. But you have to have certain exceptions when you're looking at computing the book value itself. Now, a lot of value investors look at book value and they probably look at standard deviations for book value as well. Anything below 1 is probably undervalued, but not necessary, as I mentioned earlier, for various factors that can grow as well. Again, it does not mean that a price to book which is below 1, it can actually mean to be a poor ratio for some other industry which is probably expected to have larger book values for companies because of the asset turnover that you've got and the asset sweating that they do. I think that point also needs to be taken into consideration. Again, I think in terms of assuming book value again, you're probably looking at the book value of an equity, which obviously excludes a lot of intangibles at place. So patents, goodwill, for example, are something that probably gets excluded in terms of the entire computation at play itself. And again, I think the past issuances of equity, which are obviously augmented by the profits or the losses in terms of retained earnings, and again, reduction in terms of, as I said, the dividends and the share buybacks. So I think that is where I think the tangible book value probably gets accounted for. The tangible book value obviously is the total book value less any intangible assets, as I said. The more useful variant of this is in terms of price to tangible value itself. Now, it can be a very, very valuable metric, but it can also be a metric where I think positive book values and negative earnings are where I think this is widely and significantly used. Largely, again, I think when you're probably looking at the entire book value concept, the other element that a lot of market participants look at is there is a reality check that a lot of investors are doing. And there's a concept called as growth at a reasonable price. So, in connotation with the price to book multiple, whether growth is happening at a reasonable price is something that is combining the tenets of growth investing and value investing for certain individual stocks. So, what is GARP all about in equation and in tandem with price to book? I think both these theories use that, and therefore, I was trying to stress upon the point of what price to book is and why GARP is an equally important strategy, which gets applied in combination to price to book as well as price to earnings multiple as well. So, what GARP investors probably look at is companies which are showing consistent earnings growth, which is above the average levels. So if you're probably looking at an industry itself or a sector itself, they're looking at companies which are consistently having better earnings growth compared to its peers, better earnings growth in terms of relative valuation compared to its sector performance on an average is as well. So I think that would include a lot of companies with lower market capitalization, higher market capitalizations as well. But growth at reasonable price includes companies which are having an earnings growth larger than the broader universe at any given point of time. Obviously, I think when you're looking at the growth at a reasonable price, the important aspect is also reasonable price, right? So whether growth and value investors who both look at this variable, they also look at the valuation aspect. So whether valuations are not too stretched at any given point of time. And the general thumb rule here is that the exclusion of companies happens where valuations remain extremely overstretched. So the entire purpose in terms of finding this and in terms of assuming and presuming the balance sheet and analyzing the balance sheet of finding the book value for finding the growth at reasonable price stocks as well is to avoid the extremes. So I think avoid the extremes of value where I think you're probably trying to assume and trying to pinpoint to get an extreme element of how to find the book and whether the book value is justified at a given point of time, which again, as I said, in the last few minutes is subject to a lot of conditions, to a lot of assumptions, and to a lot of presumptions at play, and that might or might not turn out to be true. Similar for growth, I think there are certain presumptions of the company growing at a certain clip for a certain period of time. That probably does not happen if it hits speed bump. I think that is where valuations probably also come into account. So I think GAR probably tends or leads investors to stocks which are relatively better place from a price earnings multiple in normal market conditions. And therefore, I think the entire concept in terms of how these companies are better placed in terms of their earnings trajectory itself. Now, surprisingly, I think value investors, as we all know, right? Benjamin Graham, the father of value investing, Warren Buffett, I think, one of the proponents of value investing. But the entire concept of GARP was brought in by Peter Lynch. So we must have all heard about Peter Lynch. So I think Peter Lynch was the first person who introduced the GARP concept, and the entire concept then laid its emphasis upon the PEG ratio. So I think the last ratio that we've probably put out in terms of price, earnings, and growth, I think the PEG ratio is the ratio between a company's P ratio, that is how a company is valued on a forward basis. Whether you take a couple of years forward presumption earnings, 3 years presumption earnings, and normally I think a couple of years forward presumption earnings is probably taken into account to take into account business conditions and business cycle over the next 8 quarters. The PEG ratio is the ratio between that ratio, that is the P ratio, and its expected earnings growth rate over the next few years. So as I said, I think for any investor, value or growth, I think there is a certain element of presumptions that are put in terms of how that company is expected to grow from an earnings perspective, and you're pegging that based on different parameters, different assumptions over a period of time. How that earnings rate is expected to grow, and the difference between the P and the earnings ratio is how the PG ratio is pegged out. Now, similarly, in the case of price to book multiple, where the ideal situation, as I said, the ideal situation is that a PB ratio less than 1 is considered to be extremely good and extremely supportive from a valuation perspective. A PEG ratio of less than 1 also means that the P ratios are in line with the expected earnings growth, and that the company is poised to deliver larger earnings growth. And it also helps to probably understand that the companies from a valuation matrix perspective on how they are placed at a given point of time. So again, I think it's different positioning in different markets at any given point of time. So value investors, as I said, are looking for bargain prices, and at that point of time, I think value investors, if you've heard Warren Buffett and how Warren Buffett has probably put forth his entire argument. I think the entire principle that they lay about is margin of safety. So they do not buy into that efficient market hypothesis theory, where the basic presumption is that the market prices that are getting reflected are fair values, and that the fair values are getting indicated in market prices that are getting indicated at every given point of time. Again, I think going forward, what happens in terms of going forward is how these assumptions are getting played out. So I think the value investors probably look at the margin of safety theory. They do not buy into the efficient market hypothesis, which basically means that what the stock prices are showing at this point of time have not taken everything into consideration, but it's not fair enough in terms of the fair pricing that the markets are indicating, and they try to find out stock depending on the intrinsic value. And therefore, I think the entire concept of GARP, which gets associated with PB, PEG ratio itself, that itself is extremely important as well. Now, what is intrinsic value, right? I mean, I just stressed upon that point. So, intrinsic value uh, can have different connotations as well. So, for an investor, I think the intrinsic value of an asset obviously is how the asset calculation is based on. So some economists are of the belief that intrinsic value, as I've said, and we've discussed this, can be pegged in terms of the assumptions that we probably do on the price to book, price earnings, and the PEG ratio multiple, while others possibly also are of the belief that you're probably looking at the discounted cash flow in terms of valuing stocks as well. The interesting part in terms of calculating interesting value of options, right? Because there is also an option theory involved in terms of calculating intrinsic cost. So when it comes to valuing options, it is pretty simple at this point of time. So you just have to take the difference between the stock's current price and the option strike price. So to find the intrinsic value of options, I think the simple calculation metric is taking the difference between the stock's current price and the options strike price, and then multiplying that by the number of shares your options entitle you to buy. So the number of options that you're probably looking at buying has to get multiplied by the difference between the price, the CMP, and the options strike price. Again, I think the important point to be noted here is that options which are not in the money, which means that the strike price is greater than the market price, have no intrinsic value and they're only trading for time value. So I think that is the most important difference that you should be probably taking into account as well. So options, again, I think which are not in the money at any given point of time, the basic presumption between that logic is that the strike price is greater than the current price, they have no intrinsic value, and they're trading only for time value. Uh, Now, to come to the assumption in terms of discounted cash flows, and just briefly and tersely touch upon that point, what discounted cash flow basically does, it is uses the time value of money. So the concept of time value of money, along with an estimation of company's future cash flows, how much is the company be able to generate from the future few quarters perspective, from the future few years perspective. I think that is something that needs to be observed for all these companies at play. And therefore, again, I think the discounted cash flow analysis uses time value of money along with an estimations of the company's future cash flows. So I think the sum of all the present values. So when you take out all the sum in terms of discounting the future cash flows to the present value, and once you get the sum of the present value for all the discounted cash flows for the next few quarters and years that you've got, I think the value that you probably get in terms of present value is the intrinsic value of their company. So there are various variables that go in. So I'll not go into too many details on how the entire DCF calculation is done. But again, I think this is the basic presumption that is drawn about. So I think we've discussed in brief a lot of metrics that take place in terms of how the entire aspect happens on valuation of a lot of these stocks from a value investor's perspective, from a growth investor's perspective, how the GARP ratio is used by both growth and value investors, and why these ratios are important in terms of forecasting of numbers that become critical in terms of companies' performance going ahead. Now, as I said, I think there are different theories in terms of how the entire logic is. So I think, as I said earlier as well, the difference between value and growth lies in terms of your risk profile as well. It lies in terms of the efficient return on investments that you probably want to generate from different time periodicities in the market. So growth investing has its own strengths. Value investing has its own strengths as well. Value investors go, as I said, with the logic that at some point of time, the markets will realize the true potential of that stock. For growth investors, I think it is a presumption that the stocks that they're probably looking at, or the stocks which are growing at a fast clip, will continue to do that for some foreseeable future of time. And in that foreseeable future of time, the numbers that they post and the kind of returns that they generate are far higher. So I think in trending markets, I think growth investors tend to outperform. Value investors probably do far better. But I think the time periodicity and how much patience do you have from a long-term perspective is really one wants to peg about. So I think investors, as I said, Benjamin Graham, he's written fabulous books. Warren Buffett has written fabulous books as well. Known as the father of value investing, as I said, Peter Lynch as well. Growth investing, I think the company that I represent, William O'Neill India, William O'Neill himself, I think one of the founders of the methodology in terms of canceling, along with how growth investing should be done. And he's written brilliant books. So I think if you want to go through the books that William O'Neill has written, How to Make Money in Stocks, I think this is one of the books that you should probably read because that will give you a precise and a concise look into how William O'Neill looked into the markets and how the entire hypothesis was based on in terms of stock picking and how much returns the stocks have generated over a period of time and how brilliantly I think stock picking was actually done. Uh, the second element is obviously the 24 essential lessons for investment success and the successful investor that he's written. So I think he followed the growth investment strategy to the T. And though I think a lot of proponents might have thrown the idea out of the window, I think the kind of returns that William O'Neill generated, both for himself, for his clients, the institutional setup, and the advices that a lot of institutional clients across the globe got, I think they benefited very, very strongly. And again, I think it was a mix in terms of not just one set of theory or ideology at play. I think the ideology at play continues in terms of evolving systems, products, and MarketSmith, the product that has got developed, has a combination of both fundamentals at play, technicals at play. The charts are automated, which obviously means that the chart patterns are drawn by the software itself, which removes and reduces any manual bias as well. We've got the blue dot concept as well, and I'll just take a minute to note that because it's very, very interesting. And we've just introduced that into the Indian equity markets as well. So the blue dot is nothing but where base patterns have been formed very, very appropriately and where the RSI lines have hit all-time highs, which basically means that the companies have done exceptionally well, that the companies are on the right growth path. And though they might not be very, very close to the exact pivot levels, as we call it, in terms of buy points, they give you an indication and an indication of sorts, uphand and before time, that you should be monitoring these stocks on your radar, have them on your buy list, because as that count increases over days and weeks, and as those blue dots start coming out, I think those companies are doing better than what most of the others are within the same year itself. So I think the blue dot, what we've introduced in our product at MarketSmith India, I think that is something that you should probably look at. If you have not subscribed, I think have a look at the product itself. I think it's a brilliant concept. So I think he was one of the key proponents of growth investing and a very, very successful growth investor at that. I'll just quickly take you through a few examples. Again, I think these examples are just examples for educational purposes. They are in no ways buying or selling recommendations, but just a brief or a terse touch-up in terms of the entire breakup in terms of how value stocks look like and how growth stocks look like. So ITC, for example, consistent performer over a period of time. You look at the pattern that it has done lastly over the last 1 year. It moved in a quite tight range because the expectations were that the earnings will remain consistent over a period of time. This company generates huge amount of cash flows. So everything that a value investor probably looks at in terms of forecasting of future cash flows, the consistency of cash flows in terms of valuation matrix, being extremely cheap in terms of standard deviation in its own sense, as well as stacking up against its peers. I think ITC stood the test of time. But look at what has happened with ITC. So is there value? I think again, I think there are a lot of question marks drawn. There is definite value if you compare that in terms of multiples that the other FMCG players are doing at this point of time. There is a lot of value if you probably presume that the stock can generate. But look at how the stock has come off the cliff. So there are always arguments put off in terms of whether value will exist. But at what point of time will the stock start reacting? Whether the cigarette business will start doing well, whether there are excise hikes on cigarettes, which still is the largest contributor to EBIT. What about the capital employed in other lines of businesses, other FMCG, hotels, agri trading businesses, whether they will actually start throwing up in terms of better capital employed on all these businesses as well, and whether the capital efficiency plays off. I think those are question marks where assumptions probably happens from value investors' perspective. So this is one example. The second example is State Bank. Again, consistent performer, at least till the fall, like all the other stocks were doing. But then question marks started getting raised. And as I said, uh, in, in, uh, in my notes itself, uh, the presumption in terms of the future efficiency, in terms of forecasting growth, in terms of cash flows, in terms of risk, in terms of the NPA cycle itself at play. I think all these factors started getting raised. Now, even if the book value probably starts appearing far better in comparison to what the historical averages were. As I said, the three phases of the market, I think the first phase is what we already witnessed in terms of sharp correction, the shock phase. We are probably going through the adjustment phase right now, where we are trying to find out and peg certain assumptions for future earnings growth, at least on an annualized basis. And the last, as I said, over the next couple of quarters, as we enter into the second half, will be the reality phase, where reality check will actually dawn upon a lot of stocks and sectors within the larger universe, where stocks, including State Bank, will then start realizing how the earnings have been for the last 2 quarters and whether our assumptions were correct. So if the assumptions were not correct, I think the markets will then start factoring in slower growth, which will be indicative and reflective in the price itself. Or if the assumptions probably were which were assumed, and the numbers that are coming out and the commentary that is coming out is expected to be far better, so that poses an upside risk. So I think that reality check will happen across a couple of quarters down the line, but till that point of time, I think that argument will continue in terms of future forecasting for all these stocks. So this is another classic example. Tata Steel, the cyclicality in terms of commodities, and for value investors specifically, I think all the legendary investors have probably shied away from commodity stocks because I think they're very, very cyclical in terms of their earnings momentum as well. How will they react? At what point of time should you probably getting in? Should you be getting in into the peak cycle when commodity stocks are doing very, very well? When the demand is robust, the realizations are strong, when the capex starts coming out very, very strongly for these companies because of the inherent demand that we see, the leverage starts building up. So at any given point of time, I think there are always question marks. But for growth investors, I think these times are the most beautiful times. So when these times come into the markets where demand is very strong, realizations are strong, numbers are getting played out on a quarter basis to the optimum level, where the production efficiency is happening in terms of utilization of plants, their asset turns, the sweating of assets is happening at a humongous pace. That is where I think the entire pace of earnings growth will happen at a very, very fast clip. So I think it's a classical dichotomy. I think value investors at that point of time will be finding that stock extremely expensive, and as I said, the multiples that they probably peg at that point of time would be uh, uh, enterprise value on EBITDA, right? Because that is where I think the numerator denominator both are at place, where enterprise value as a denominator and the operating value as a denominator is the appropriate matrix, probably start looking expensive. But for growth investors, I think that is where growth is coming from. And at that periodicity of time or for that time series itself, growth investors will probably make hay while the sun shines. So I think they'll make a huge amount of money, while value investors will probably just set out on all these stocks. So again, an example on that sort. Escorts, again, a classical example in terms of what the stock uh, reacts to. I think how the numbers are estimated in terms of the tractor growth, for example, how the entire macro system is getting placed out. So I think it's highly beta correlated stocks in terms of a lot of variables at play at, at any given point of time. So I think these stocks tend to perform. So I think whether you generate value, because I think what kind of earnings growth will you peg out? Whether the value itself is quite cheap compared to its historical standard deviations, whether the next couple of years, from a Kharif season perspective, a Rabi season perspective, the tractor numbers itself from an agri equipment sale perspective, how construction activities happen across the country. I think all these factors are at play. So I think one more example for value. Growth, again, I think typically tend, as I said, in terms of momentum. So look at a stock like Info Edge, right? And this stock actually started hitting newer highs when the market was doing well, because I think the multiples are not considered at all. Because the multiples on any parameter that we've discussed, whether it's price to book, whether it's price earnings growth, whether it's price earnings multiple, whether it's the PEG ratio. I think all these ratios will probably look out of whack for these stocks. But for that periodicity of time, I think the numbers that these companies will keep on posting, I think, will be phenomenal. So if this is the case of how the stocks might perform, I think at that point of time, I think these stocks pay little heed to how valuation metrics are compared either to its own standard deviations or compared to the universe as well. But these stocks surprisingly do very, very well because of their high beta correlation to the market itself and how the entire purpose is in terms of positioning of these stocks compared to the others. So Info Edge is one example of growth. Navin Fluorine, for example, I think another example of so if you probably look at valuations and if you ask value investors, they'll probably talk about the stock being extremely expensive. So even if you probably assume and presume certain growth to come through and certain earnings multiple to come along with operating performance risk and the earnings efficiency, I think the standard deviations of trailing earnings and where it stacks up right now will not have any findings for a value investor perspective. But these stocks continue to grow because their earnings momentum remains extremely strong. And if earnings momentum remains strong because of many factors, for these guys, they've got a huge order flow, order book a couple of months back, leads to far more revenue visibility going forward. But the presumption here is that valuations probably look expensive, but the earnings momentum remains strong. So growth investors probably look at the earnings momentum rather than the valuation metrics, which probably is one of the other factors as well. GMM Founder, again, I think look at the growth parameters as well. The expectations is that they will keep on growing at a certain pace, but because of their balance sheet strength, the inherent nature of their balance sheet, the expectations in terms of few industries that they cater to, expected to do exceedingly well over the next few quarters and years. But at what pace might they outperform? I think that is the question mark in terms of earnings expectations that value investors put through. But for growth investors, I think the earnings are coming through and the earnings are coming thick and fast. Quarter after quarter, which means that the justifiable reasons in terms of getting into these stocks for a particular time series still exists. DMart, I think one more example in terms of how the stock has stood the test of time. So valuations had always been a concern for DMart, but look at where the stock was, where it is even at this point of time, and valuations will still keep on continuing to be extremely elevated for companies like this because of the inherent growth that they probably bring on the table. So I think the growth in terms of the top line, the earnings multiple, how much they plow back in terms of retained earnings into the business itself, how efficiently are they using their capital to grow their business and ensure return to shareholders, return on capital employed. I think all these are important aspects and facets as well. So in that respect, I think this is one more example in terms of growth investing. And therefore, I think the entire concept on how value and growth investing is perceived or looked at. Now, the blue dot, and as I touched upon, I think the blue dot is an interesting list. So if you have not looked at that, my own presumption is our product has actually started this product, this innovation feature. This innovative feature is nothing but uh, this innovative feature is nothing but identifying the next potential breakouts or ideas ahead of time. So as I said, I think the blue dot, as you see on the screen, I think that is an indicative factor that the stock has hit its new RSI line, and that the supportive factors, both fundamentally and technically, are very much there because I think we use both these elements in terms of stock identification, and it is expected that these stocks are forming a proper base along with the new RSI lines that they've created, and this will give you enough time. So I think it's a clear pre-indicator for all investors that you keep a watch for these stocks because you can study these stocks because these stocks can potentially give you that huge breakout that you're probably looking at on all these parameters that I discussed over the next few days or weeks. And those few days or weeks, I think, is sufficient preparatory time for you to probably look at the fundamentals in the product itself, look at the technical indicators in the product itself, to see how you can probably take advantage of that. As the number of blue dots keep on increasing, and if they do, and as the count goes up for that particular stock over the next few days or weeks, I think you got a strong winner on your hand. Arc Industries, I think, is a key example of a blue dot. This was indicated, and that stock actually gave a huge breakout. Fundamentals in place, sweet positioning in terms of the industry itself, but this is what the software is throwing out from the perspective of blue dot. As I said, and this is just a minute that I'll take for you guys to just state what the entire blue dot concept is. Try and answer a few queries if I'm not able to answer the entire queries, I will try or my team will try and get back in terms of how to answer that. So let me get back to you in terms of the query stack up, and then we'll answer the queries at hand.
Hello.
So the question, couple of questions. I mean, couple of questions that are getting asked. I'll just try and answer quickly on this. So Smriti Kapoor Malik has asked 2 or 3 questions. Do you see inflationary risks on upside given disruptions in supply chain, and do you think this will restrict RBI to cut rates further? Also push down long yields and therefore pushing valuation lower. Do you think all the leverage is out of the system given the sell-off in March? And how do you expect FINs and FPIs to act in the near future? So I think the inflationary risks, and if you look at the RBI commentary and the RBI statement coming through, they obviously expect it to soften up. There might be some element in terms of surprises that you might get in the short term, but I think the inflationary risks should start coming off. Yes, because of supply chain factors, I think there might be, as I said, some element in terms of a surprise that you'll probably get. But over a period of time, at least in the second half, that should probably normalize. RBI has been very, very proactive, whether it's been the flows from the NBFC perspective, the 50,000 crores that they meted out, the mutual fund bailout money that they're doing at this point of time. So again, I think the longer term yields